What's crackin' trading family? Your boy Wildcard? 4 monitors glowing, Rockstar sweating, and the tape's got 3 landmines stacked before noon. TB's locked in next to me, coffee black, eyes on the futures board. Let's get it.
Quick reminder, nothing we say is financial advice. We're two guys with screens talking markets, not telling you what to buy. Do your own research, know your risk. Futures are flat to slightly lower. Dow futures down 30 points, S&P futures down 5, NASDAQ down 10. The VIX is sitting at 15.93, so the fear isn't spiking, but nobody's asleep. Overnight, the Kospi got wrecked, down 6.37%. The Nikkei dropped 2.79%. Europe is modestly negative. The DAX off 0.42, the FTSE's down 0.34. Yet US futures are holding despite all that. That's the first tell. There's a bid underneath, but the 8:30 a.m. print is the real gatekeeper.
Gatekeeper is exactly right. The biggest story today isn't Iran. It's not the Kospi meltdown. It's the Fed's split that nobody stitched to the energy trade. Kevin Warsh went hard in Senate testimony yesterday, calling for what he called regime change. Kill the inflation tax, hawkish as it gets. Same day, New York Fed President John Williams says inflation has likely peaked and rates are well positioned. 2 heavyweights, opposite movies, and the tiebreaker drops in about an hour. Core PPI at 8:30 a.m. Eastern. Consensus is 0.3% month over month, up from 0.1% last month. If it comes in soft, Williams wins. Bonds rally, the dollar weakens, and oil gets a clear runway because the Fed won't hike into a supply shock from Hormuz. If it's hot, Warsh wins. Equities sell off, and energy becomes the only safe haven left. That connective tissue between the PPI print and the Iran Strait trade is the thing the street is skipping entirely.
And that divergence is why the tape feels so split this morning. Nobody's linking the inflation data to the physical crude narrative, but the mechanics are screaming it. A soft PP. I keeps the Fed accommodative while Hormuz supply risk pushes crude above $80 sustained. That's the double green light for energy. A hot print tightens financial conditions, and you end up with a risk-off equity tape where energy is the only sector standing. Either way, the energy trade survives. The question is what it takes down with it.
Exactly. So that's the frame. Let's go deep on the second story. The one that's bleeding through the pre-market. TSM prints before the bell. $3.87 is the estimate. But TB, the Korean mechanics are what scare me more than the number itself.
The number is almost secondary. TSM's earnings are a sentiment anchor, but the real damage is plumbing. The Kospi closed down 6.37% overnight. SK Hynix, the memory giant, dropped 11%. That's not a normal sell-off. At 2 a.m., a Bloomberg piece dropped saying Korean regulators are about to announce leverage ETF rule changes, higher minimums, rebalancing restrictions. And tomorrow is a Korean holiday. So retail traders who were levered into semi-ETFs got margin called in a thin market that's about to close for 2 days. That forced selling doesn't disappear. It funnels straight into US ADRs and the 2 times leveraged ETFs here, in liquidity that's already thin. TSM beating on earnings and guiding strong on 3-nanometer artificial intelligence CAPEX doesn't fix that mechanical spillover. It can soften the sentiment, give a floor for NVIDIA and AMD, but the unwind takes days, not hours.
So if TSM misses, we get a wave of wreckage that compounds through Monday because you've got no Korean market to absorb it until Tuesday. That's the nightmare case. But I hear you. A beat fades into lunch because the ADR mispricing doesn't care about fundamentals for the next 48 hours.
Right. My wave trader algo is holding AMD with a $517 entry, stop at $493. That stop isn't a casual number. If AMD breaks below 493, it means the Korea forced selling is accelerating and the structural bid is broken. I'm not touching anything new from my gut book. My paper account is 0 for 3, and this is not the tape to force a redemption trade. BYD is still alive at $87.64, stop at $82. I'm letting that breathe.
Smart. Let's start the third story, the one I've got my gut book in, the Hormuz structural overlay. The IEA chief came out yesterday and flat out warned the global economy is in peril if the Strait of Hormuz crisis persists. Iran called the strait their red line overnight. Trump said he's striking infrastructure next week if diplomacy fails. This isn't a headline cycle. This is the macro driver for the third quarter. And the refiner angle is what caught my eye. MarketWatch ran a piece spelling out that U.S. complex refiners could triple profits if crude flows get disrupted because crack spreads blow out. The names PBF, MPC, PSX, VLO, the energy sector. ETF energy sector. ETF is still lagging the crude spot move. The energy sector ETF at 56.50, while crude's pushing higher. My gut call account added another $2,000 to the energy sector ETF at market this morning. That brings my total to $4,000. Stop at $54.30. But let it run.
That's a heavy conviction ad. I'll flag the Warsh testimony wildcard. Warren grilled him hard on energy prices on Wednesday. If she gets another round today, that headlines the entire PPI window and creates intraday chop for energy names. The structural thesis gets stronger, but the volatility gets nasty. Your stop is tight, so you're protected.
Exactly. If Warsh gets grilled, I sit on my hands. The thesis doesn't change. So that's the three-story spine, PP, I tiebreaker, TSM, and the Korea unwind, and the Hormuz layer cake. Quick earnings wrapper, TSM pre-market. We covered that deep. After the close, Netflix reports 0.79 cents estimate. Netflix is the canary for streaming and consumer discretionary. A miss there dents the growth narrative heading into tomorrow's retail sales. Tomorrow pre-market, TRV, TFC, FEET-B, RF, ALV, SPF SPY, not Exxon or Verizon today. If Exxon prints strong, the energy sector ETF trade gets structural confirmation before the opening bell.
Monday morning picks up those prints, but Friday's calendar is dense. Here's today's setup. 8:30 a.m. is core PPI month over month, consensus 0.3%, prior 0.1%. Headline PPI month over month consensus is flat at 0.0%, but that's after a 0.6% jump last month. Year over year PPI is expected at 6.2%, up from 6.0. A hot core number hardens Warsh's hawkishness, lifts the dollar, and hits equities. A soft print fuels the bond rally and weakens the dollar, giving oil more runway.
And tomorrow's data is sneaky big because it lands after that. UK GDP month over month. Consensus 0% after a minus 0.1% prior. But the US retail sales are the main event. Core retail sales month over month consensus 0.0% versus a prior 0.8%. Headline retail sales at 0.2% after 0.9%. The control group number inside retail sales is what I'm watching. That tells you underlying consumer demand. If retail sales miss, the consumer discretionary trade gets hammered, which puts even more pressure on Netflix.
And Saturday, we get the Michigan inflation expectations. The 1 year at 4.6% prior, the 5 year at 3.3%. That's the early read on consumer inflation fears. If those tick up, it feeds back into the Fed's narrative. So the whole week's macro arc runs from PPI to retail sales to consumer sentiment, all against the backdrop of Hormuz.
That brings us to sector rotation, which is screaming cyclicals. Over the past week, the leaders are XLC, communication services up 3.58%, the financial sector. Financials up 2.89%, the energy sector, ETF, energy up 1.62%. Laggards are XESU utilities down 0.31%, XLP, consumer staples down 1.09%, and XLV healthcare down 2.47%. Money is rotating out of defensives and into cyclicals. That's a higher for longer rate backdrop, plus real energy structural bid. But the energy sector ETF is still the middle child. It's not leading the tape, which means there's room if crude holds and PPI cooperates.
That rotation into financials fits if the Warsh view wins and rates stay elevated. But if PPI comes in soft and the dollar drops, the rotation could pivot hard into commodities and energy, catching up fast. The international plumbing supports this. The KOSPI crash is the headline, but the carry trade isn't unwinding yet. US DJPY is flat, dollar index unchanged. There's no yen spike today. The Korea problem is contained to forced ETF deleveraging, not a broad margin call contagion. Yet, but a hot PP, I could spike the dollar and trigger a carry unwind, which would hit US tech through the same 8R channel. So the stability in FX is fragile.
So the international tape feeds back into our three binaries. Now let's zoom in on the portfolio hot theme. The Hormuz energy layer cake, TB. Break down the structural case.
The bull case is straightforward. Physical supply risk from the Strait pushes crude above $80 sustained. U.S. complex refiners benefit because their heavy crude input from Saudi gets disrupted, while product prices spike on the output side. Crack spreads widen hard. The Fed, if PPI is soft, stays accommodative and adds fuel to oil demand without rate headwinds. That's the regime trade that survives both risk on and risk off. The names are PBF, MPC, PSX, VLO, and Broad, the energy sector ETF, which WC is in. The bear case is that diplomatic resolution removes the risk premium, or that Warren's pressure on Warsh forces jawboning on energy prices that caps the rally, plus demand destruction if retail sales tomorrow show the consumer is tapping out, and the energy sector ETF still lags crude. If crude corrects, energy stocks give back gains fast.
And the second order effects matter. Higher energy costs feed back into P, PI, and CPI, tightening financial conditions even without Fed hikes. That squeezes consumer discretionary. Airlines, manufacturing margins. That's exactly why Netflix, after the close and retail sales tomorrow, are so key. They tell us if the consumer can digest rising energy. My paper account is positioned for the bull case. WaveTrader Algo is sitting on now, AMD and S, waiting for a clean gate. TB's gut book is in BYD, writing it.
I'm not adding today. My paper record needs to earn the next entry. The quote, here's what we're watching tomorrow. Core PP. Eye reaction dictates the morning tone. Hot print equals equities, bleed, and energy as safe haven. Soft equals bonds, rally, and oil runway. The S&P support is at 4,400. Then 4,350, NVIDIA support at $420. If that breaks, the semi-route accelerates. Crude pivot at 76.50. The energy sector ETF stop at 54.30, above 57 targets. My AMD stop at 493. That's the line in the sand for the sector. TSM follow through, Netflix after hours, and Exxon pre-market Friday. Respect the 8:30 a.m. print, respect your stops, and don't chase the first move. I'm WC, that's TB, we're out.
Yo, what's good, trading fam? Your boy is live, 4 screens, rockstar sweating, and we've got a 3-binary morning that could shred the week. TB's sitting silent, coffee black, scanning futures. Let's roll.
Quick disclaimer. Nothing we say is financial advice. This is just 2 guys with screens talking through what we see. Do your own work, know your risk. Futures are flat to slightly lower. Dow futures -30, S&P futures -5, NASDAQ -10. VIX is at 15.93, elevated but not panicked. Overnight, we watched the Kospi implode 6.37%, Nikkei drop 2.79. Europe is modestly red. Yet U.S. futures are holding. The tension is clear. The 8:30 a.m. core PPI print is the gatekeeper.
That PPI print is the real story. Nobody's connecting. Kevin Warsh testified yesterday calling for regime change. Kill the inflation tax, hard hawk. Same afternoon, John Williams said, inflation likely peaked, rates are well positioned. 2 FOMC voices, opposite camps, and the tiebreaker drops in less than an hour. Core PPI consensus 0.3% month over month versus prior 0.1%. If it prints soft, Williams wins. Bonds rally, dollar drops, and oil gets a runway because the Fed won't hike into a Hormuz supply shock. If it prints hot, Warsh wins. Equities sell off and energy becomes the only safe haven. That PPI tow, Hormuz pipeline, is the connective tissue the whole street is missing.
That's the frame, and it puts the TSM print in a strange spot. TSM reports pre-market estimate $3.87, but the real driver is mechanical. Overnight, a Bloomberg piece said Korean regulators are about to announce leverage, ETF rule changes, higher minimums, rebalancing tweaks. Tomorrow is a Korean holiday, so retail traders levered into semi-ETFs got margin called in thin trade, and that forced selling has nowhere to go except US ADRs and 2 times leveraged ETFs. TSM beating doesn't fix that plumbing. A beat can give sentiment a floor for NVIDIA and AMD, but the forced unwind takes days. If TSM misses, the washout accelerates through Monday because there's no Korean market to absorb it. My WaveTrader Algo is holding AMD, entry $517, stop at $493. That stop level matters. A break below signals the forced selling is deepening.
So the semi-trade is mechanical, not sentiment. Got it. Let's flip to the third story. The Hormuz structural overlay, and this is where my gut account is. IEA chief warned yesterday the global economy is in peril if the Strait crisis persists. Iran says the Strait is a red line. Trump threatens infrastructure strikes next week. This is the macro driver for Q3. MarketWatch highlighted that complex U.S. refiners could triple profits if crude flows get disrupted. Crack spreads blow out when heavy Saudi crude is cut off. That's PBF, MPC, PS, X, VLO. The energy sector, ETF, is still lagging crude spot, sitting at 56.50 while oil pushes higher. My gut call account added another 2,000 at market this morning. Total 4,000, stop at $54.30. Let it ride.
One risk. Warren grilled Warsh hard on energy prices Wednesday. If she goes again today, that creates headline chop for energy names. Your stop is tight, so you're fine, but intraday could get nasty. The thesis is structural.
Noted. Let's quickly hit earnings. TSM done. Netflix, after close at 0.79 cents. That's the consumer canary. Tomorrow pre-market. TRV, TFC, VP, RF, ALV, SPI. Not Exxon or Verizon. If Exxon prints strong, the energy sector. ETF trade gets confirmation.
Calendar-wise, today's 8:30 a.m. core PPI 0.3% month-over-month headline PP. I flat at 0%. Year-over-year PPI at 6.2%. Hot dollar up, equities bleed. Softy bond rally, dollar drops, oil runs. Tomorrow retail sales are key. Core retail sales 0% after 0.8% prior. Headline 0.2% after 0.9%. The control group inside that number is what tells us about real consumer demand. Saturday Michigan inflation expectations, 1 year prior 4.6%, 5-year at 3.3%.
Sector board shows cyclicals leading. XLC Communication Services up 3.58% this week. The financial sector. Financials up 2.89. The energy sector, ETF, energy up 1.62. Laggards. XLU Utilities down 0.31. XLP. Staples down 1.09. XLV. Healthcare down 2.47. Money is rotating out of safety and into cyclicals. Higher for longer backdrop with an energy bid. The energy sector, ETF, is the middle child, underperforming crude, so if oil holds, it has room.
International plumbing, the Kospi crash is the headline, but USD/JPY is flat, no yen spike yet. The carry trade isn't unwinding broadly. The Korea problem is contained to forced ETF deleveraging, but a hot PP, I could spike the dollar and trigger a carry unwind, hitting semis even harder through the same ADR channel.
So the Hormuz layer cake, bull case is crude above 80 sustained, refiners profit triple, Fed accommodative if PATI soft. Bear case is diplomacy kills the premium or retail sales show demand destruction. Second order effects, energy costs feed into inflation, squeezing consumer names. That's why Netflix and retail sales matter. I'm positioned with the energy sector. ETF, stop tight. TB's algo is holding now. AMD, S, his gut book, BYD at 87.64, stop 82. He's not adding.
Tomorrow's levels, S&P support 4,400, then 4,350. NVIDIA support $420. Crude pivot 76.50. The energy sector ETF stop 54.30, above 57 targets. AMD stop 493. Respect the 8:30 AM print, respect your stops, don't chase the first move. NWC, that's TB, we're out.